This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you by...
Sailing through the heart of historic cities and landscapes on a river, you get close to iconic landmarks, to local life, to cultural treasures. Viking River Cruises, exploring the world in comfort.
Looking for clues. The Fed didn't give any. The timing of the stimulus slowdown still uncertain, leaving investors scratching their heads. So what happens next?
The young and the uninsured. A new report shines light on what this group may do when open enrollment begins, and it could determine the success or failure of the president's health law.
And low octane. ExxonMobil shares are running out of gas, down 20 of the past 21 sessions. Should investors be worried? We have all that and more tonight on Nightly Business Report for Wednesday, August 21st.
Good evening, everyone, and welcome. Well, as the basketball announcer Marv Albert likes to say, at the critical moment of a game or series, it's all come down to this. When exactly will the Fed begin, in the verb of the summer, to taper its bond buying? Well, today, investors sought clarity in the minutes from the Fed's July meeting. They didn't find it. The market's forensic scientists probed and prodded the meaning of words like patience and soon. But how soon is soon? How patient is patient when an economy's fate is at stake? All that was really clear is that Fed officials seem broadly united that the bond buying will end eventually, maybe by mid-2014, or not if the economy stumbles. The lack of definitiveness is why the Dow swooped, swooned, soared, and sank today, down 122 after the release of the minutes, then up by 17 briefly before closing down 105. The Dow finished below the 15,000 mark for the first time since July 30. It was the sixth straight losing session for that barometer. The Nasdaq lower by 13 points and the S&P 500 off by 9. Meanwhile, Treasury yields moved like the British boy band, one direction, up, constantly up to 2.9% on the 10-year bond. Now, with so much uncertainty about the markets and the Fed's tapering plans, the Fed has a lot on its plate, enough to make them head for the hills, which is what they did. Steve Leisman has our report from the big Fed conference in Jackson Hole, Wyoming.
Good evening from Jackson Hole, Wyoming, where the Federal Reserve gathers every year for its economic retreat on monetary policy and the economy. And this year there is a high but an unprecedented level of uncertainty surrounding this meeting. Every 4 years they get together with uncertainty about who will be the Fed chairman. In 2009, it was whether President Obama would reappoint then Fed Chairman Ben Bernanke. And then 4 years before that, it was who would succeed Fed Chairman Alan Greenspan. Well, this year, it's who's going to replace Fed Chairman Ben Bernanke. And there's two leading candidates, Janet Yellen, the vice chairman now, and Larry Summers, the former Treasury Secretary, who was President Obama's economic advisor. Both have their pluses and minuses, and the leading candidate here thought to be Larry Summers. A big difference this year is the Fed chairman will not be attending. Neither will the head of the European Central Bank, Mario Draghi. Other top Fed officials will be here, like Bill Dudley, the president of the New York Fed, Jim Bullard from St. Louis, and John Williams from San Francisco, along with Christine Lagarde, the head of the IMF, as well as really central bankers from around the world. Some of the big topics this year will be whether or not quantitative easing is working, and if it's not working, what the Federal Reserve should do instead. Also, is the Fed communication strategy adequate? The conference begins tomorrow night with a dinner, and then there'll be academic papers and discussion over the next 2 days. And I think one of the things I'll be listening for is whether or not the Federal Reserve believes the economy is strong enough for it to reduce its stimulus for the economy as soon as September, or whether or not that will happen later. For Nightly Business Report, I'm Steve Leisman.
We turn now to Liz Ann Saunders for her thoughts on the Fed and the markets. She's chief investment strategist at Charles Schwab and Company. So, Liz Ann, it seems like there were a lot of doubts, a lot of confusion about what was in those Fed minutes, what the Fed will do next. What do you think was the message of the markets? And just what do you think in general about what's next for the markets?
I think the skittishness of the markets may be more than just confusion about the Fed minutes today. I don't know that provided a lot of additional color. But we put a note out about 10 days ago saying we thought the market was going to pull back. Now, uncertainty about Fed tapering and the implications for that is part of the reason for that. Again, I'm not so sure that the minutes specifically were a function of today's volatility. I think we're just in a fairly skittish environment right now for the market, at least in the short term.
You know, Lizanne, we sort of know that the bond buying will end. What we don't know is when the end will begin. What's your guess?
Look, I mean, we have no reason to think that it's going to be other than what the consensus believes, which is at least an announcement on September 17th or 18th, which is the next meeting, and maybe an announcement as well as the beginning of a tapering. You know, the Treasury is issuing fewer treasuries right now, so I hope when the Fed does this that they put the tapering in the context of lower Treasury issuance, so they're really not changing the supply-demand balance. In fact, if they were to continue buying at this pace, given lower issuance, they'd be buying an even bigger portion of outstanding treasuries. So I think they could maybe ease some concerns and really cement the idea that tapering is not tightening.
You know, you just mentioned your report that you came out with last week that was titled Pause, but you also say in that report that long-term things look good. Why are you positive on stocks?
Again, I think, you know, we're probably in a bit of a pullback mode here. I don't think it's going to be terribly sinister, but seasonals are against us right now, at least as of a week and a half ago. Sentiment was against us, some technical deterioration, and we may not be through that. But looking past some of those near-term issues, looking past other two macro issues with the implementation of Affordable Care Act, the second round of sequester cuts, valuation is still pretty reasonable. Corporate earnings are pretty decent. And I think investors are only now, 4.5 years starting to get more enthusiastic about the market. So there's really very little indication that what I believe was a secular bull market that began in March of 2009 is coming to a close. That said, there are going to be times in a long-term bull market where you need to pause, you need to correct a little bit, sort of the pause that refreshes, and I think that's the environment. But I'm not swayed by the short-term worries in terms of my long-term optimism.
Are you in the camp, Lizanne, with so many others who think that the U.S. economy may be the one sort of place that outperforms in the short term, and that hence U.S. stocks are a better bet over the next few months than emerging markets or foreign stocks?
No question, Ty. We've had a decidedly pro-U.S. stance in our global asset allocation views right now, certainly relative to emerging markets, which we have been suggesting investors lighten up on, particularly China. So U.S. is our favorite market. Second to that outside of the U.S. would actually be European equities right now. But we are a big believer in the relative U.S. story.
Tell us real quickly, we have half a minute. You said that your clients are feeling, investors are feeling enthusiastic. What is the mood? Where are they putting their money? I'm talking about the individual investor.
Yeah, they're feeling a little bit better, and I think, you know, the market's gains certainly support that. But I think investors are now starting to look past some of the policy uncertainty, starting to get a little bit more enthusiastic about the fundamentals. Again, in the near term, I think there's some hurdles, and I would say concern about Fed tapering is probably the #1 list of short-term concerns in an environment otherwise of improved sentiment.
All right, thanks a lot. Lizanne Saunders from
Thank
Charles
you.
Schwab and Company.
Well, nearly 5 years after the financial crisis, not one criminal case has been brought against executives who nearly brought the U.S. economy down with risky behavior, toxic investments, reckless trades. But that could change. U.S. Attorney General Eric Holder told the Wall Street Journal that, quote, anybody who's inflicted damage on our financial markets should not be of the belief that they are out of the woods because of the passage of time, end quote. Holder wouldn't say who's in the DOJ's crosshairs, if anybody, or specify whether any charges will be criminal or civil. But he did mention individual people as well as institutions are being looked at.
A new survey says that most high school graduates are not ready for college-level coursework. The folks who administer the ACT college entrance exams report that only 39% of high school graduates tested this year met 3 or more of the 4 benchmarks in English, reading, math, and science that would prepare them for higher learning. Nearly a third of all graduates, 31%, met none of the benchmarks. And just a quarter of this year's high school graduates cleared the bar in all 4 subjects.
More Americans are working these days, but only part-time. A new report from Reuters shows that 3 out of 4 of the nearly 1 million new hires made this year were for part-time workers, and many of those jobs are in low-paying fields like retail and food service. Some companies are reluctant to take on more full-time staffers because economic growth has been tepid. They also say that providing health care coverage to workers under the Affordable Care Act would drive their business costs too high.
While employers worry about the cost of providing coverage for workers, we're just 6 weeks away from when state and federal health care exchanges are slated to be operational under the Affordable Health Act. One of the biggest challenges for administrators, getting the word out to people who may need to sign up for coverage, especially to young people, many of whom say that they aren't focused or even aware of what they have to do and spend to obtain health insurance. Bertha Coombs has the story.
In health policy circles, they're called young invincibles. Healthy 20-somethings who don't buy insurance, it's assumed because they don't prioritize it. But a new report from the Commonwealth Fund shows otherwise.
Affordability is really the key reason why young adults don't enroll in health plans.
Researchers found 2/3 of 19 to 29-year-olds they surveyed take up insurance when offered at work.
And among those who don't, 22% say that they couldn't afford the policy, and only 5% said they didn't sign up because they didn't need it.
15 million young adults in their early 20s are now covered under the Obamacare provision, allowing them to stay on a parent's insurance plan. And the survey shows the number is rising.
I plan on, using my mom's insurance as long as I can.
I'll stay under it until I'm 25 or 26.
And while so-called Obamacare remains controversial, the survey found politics doesn't enter into coverage choices. Commonwealth found 63% of those who identified themselves as Republicans were covered under parents' insurance plans, up from 54% in 2011. That compares to 45% of self-described Democrats, down from 50% in 2011.
What it says is this has been a long-term problem for all families, regardless of their political affiliation. Being able to come onto their parents' policy really did benefit young adults.
For 2014, the challenge is getting young adults who can't obtain coverage through their parents to buy insurance on their own. The Obama administration is hoping to sign up at least 2.7 million young people through state health insurance exchanges. Beyond traditional advertising, the Department of Health and Human Services is using social media to try to reach them. But they aren't alone. The Heritage Foundation has launched a counter-campaign to coincide with this fall's open enrollment on social media platforms to get young people to post pictures of themselves with the hashtag #StopObamacare.
We want to package the information in a way that the user, the reader, is going to actually be able to digest it. And we just want to meet those people where they are.
Both sides of the Obamacare divide will be watching young adult enrollment closely this fall because without their participation, the insurance market will suffer from adverse selection. That is, only older and sicker people applying for coverage, which ultimately will push premium prices higher. With 80% of uninsured young adults eligible for federal subsidies, Commonwealth's Sarah Collins expects to see strong enrollment, but the bottom line will be the premium price.
Affordability is going to be key.
For Nightly Business Report, I'm Bertha Coombs.
Still ahead, ExxonMobil's losing streak. It's the worst performing stock in the Dow this month. What's going on at one of the world's largest energy companies? We'll take a look. But first, here's a check on the closing numbers for the international markets today.
It is still August, but Walmart is out with an early Christmas gift for some of its shoppers starting September 13th. The world's largest retailer will offer a free, no-interest layaway plan and will even eliminate the $5 account setup fee to help its lower-income shoppers budget their holiday spending.
Toys R Us is also gearing up for the holiday season. The nation's largest toy store chain announced that it's expanding its price match guarantee on toys from any online retailer, including Amazon or Walmart.com. Toys R Us already matches prices on identical items with its brick-and-mortar competitors.
Big week for retail earnings continues with Target, and that's where we begin tonight's Market Focus. Busy night here. The nation's second largest retailer by sales, behind Walmart, is warning that its annual profit will likely be near the low end of its forecast. The company says its expansion into Canada is costing more than anticipated and that sales in the U.S. are being pressured by a cautious consumer. Shares fell more than 3% to $65.50. Shares of Staples dropping sharply after reporting weaker than expected quarterly results. The largest U.S. office supply chain cutting its earnings outlook for the year because of soft sales in Europe and Australia. The stock slumping 15% to $14.27. That made it the worst performing stock in the S&P 500 today. Similar story for American Eagle. Fewer customers shopping at the teen retailer, which is forecasting a big drop in profits for the current quarter. The company citing increased competition and a heavy level of promotions, which the CEO calls unprecedented. The stock fell more than 9% to $14.76. And the housing recovery helping Lowe's bottom line. The home improvement retailer reporting a rise in profit and boosting its fiscal year outlook as Americans spend more to spruce up their homes. The CEO characterizing demand for home improvement products as strong. The stock rose almost 4% to $45.81.
Sticking with housing, Toll Brothers saw revenues jump thanks to higher home prices. The luxury home builder says it expects to raise prices again in the quarter despite rising mortgage rates. Toll CEO says the recovery is, quote, real, and he sees early stages of the rebound. Shares rose a fraction to $31.65. More signs today that the once mighty Hewlett-Packard is still struggling from the slump in PC sales. Quarterly earnings were in line with analyst estimates, but revenues dropped 8%. The company reported that PC sales plunged more than 22% during the fiscal third quarter. HP, though, still raised its outlook for the rest of the year. The stock dropped almost 2% to $25.38 in the regular session and then fell even more in after hours. And the ExxonMobil losing streak continues, the stock falling in 20 of the last 21 trading sessions. Exxon, along with Chevron, have accounted for about 1/3 of the Dow's point losses this month. Exxon fell fractionally today to close at $86.42. Shares are down more than 9% since the end of July.
So what's going on with these two oil giants, Exxon and Chevron, especially with energy prices so very high? Here to tell us why is Pavel Molchanov. He's an energy analyst with Raymond James. Pavel, welcome. Good to have you with us. Why are these two shares struggling so much?
Sure. I mean, several reasons. One is very simple. Until maybe the last week or so, we've been in a bull market for equities. Exxon and Chevron are inherently defensive stocks. They are simply not in favor in the context of a bull market where investors generally want something more growthy, higher beta, more speculative. This is the very opposite of high beta or speculative. Second reason is, refining stocks have also been very weak lately because the spread between the price of Brent crude and WTI has compressed. And remember, we think of Exxon and Chevron as oil producers, and for the most part they are, but they also have a big U.S. refining business which has suffered as those spreads have tightened. And then thirdly, yields have gone up, as we all know, and yield-bearing securities have generally traded off in that context. And both Exxon and Chevron are, high dividend yielding stocks, always have been.
Pavel, yet you have right now buy recommendations on both Chevron and Exxon. Is it because they've gotten so low that they have, good opportunities? What's the story there?
Yeah, I love these stocks here. I mean, they are, particularly if investors, as we do, believe that oil prices are going to soften into next year. We think there is quite a bit of downside to oil. And in the context of falling oil prices, it is precisely these kinds of high-quality defensive energy stocks that tend to outperform. Now, last 6 months, it's been the smaller cap, more higher beta, E&P independents, some of the service companies that have done better. And certainly we think there are opportunities in those sectors too. But these mega caps screen very well again, if in fact oil prices do soften into next year.
So if I own, as many of our viewers presumably do, Exxon as a core holding, maybe Chevron as a core holding, partly because they like the yield on those stocks, you would say definitively hold those stocks and maybe buy on weakness.
Yeah, we would absolutely be buyers on weakness. Again, if oil prices do weaken into next year, and the futures curve is telling us that, supply-demand analysis we've done tells us that, these stocks should do relatively better than most of the smaller, higher beta energy stocks.
So tell us about oil prices. You keep saying that if they go down, how much could they go down this year or next year? Right now, West Texas crude is $104 a barrel.
Yeah, well, we think that by the end of the year, it's going to be in the low to mid 90s, so down, 10%, maybe more. And then next year, we think WTI could potentially get into the 70s. Now, that depends obviously on a lot of factors. For example, right now, the price of oil is being propped up by Egypt, even though the Egyptian political crisis has absolutely nothing to do with oil supply whatsoever. So psychology has propped up the price because of the news flow on TV, but that's all it is. It's just a fear trade, pure sentiment.
All right, Pavel, thank you very much. Pavel Molchanov is an energy analyst at Raymond James. And coming up, Whirlpool felt the pain of the housing bust and now is riding the recovery. The stock soaring, sales surging. But could the appliance maker be in for a bumpy ride ahead? First, though, how commodities, treasuries, and currencies perform today.
Those western wildfires that have scorched thousands of acres of land from Arizona to Washington state just got a lot more costly. New estimates in Boise, Idaho show that the cost of fighting this season's fires has already topped $1 billion. 48 wildfires are still raging and uncontained around the country, and nearly 18,000 firefighters have been dispatched to fight them. Two blazes in Idaho near the resort towns of Ketchum and Sun Valley are currently the nation's top priorities.
Facebook founder Mark Zuckerberg wants to bring the internet to everyone on the planet. Zuckerberg announced the launch of Internet.org, an initiative aimed at bringing internet access to the 2/3 of the world's population that is now unable to get online, mostly in third world and emerging nations. His company is teaming up with Nokia, Qualcomm, Samsung, and others to lower the cost of internet access and help businesses create new ways to drive internet availability. Zuckerberg spoke about the idea this morning on CNN.
We use things like Facebook to share news and catch up with our friends, but they're going to use it to decide what kind of government they want, get access to healthcare for the first time ever, connect with family hundreds of miles away that they haven't seen in decades. Getting access to the internet is a really big deal. I think we're going to be able to do it.
Meanwhile, another tech giant, Apple, is having trouble gaining access to customers in China. Apple's share of the Chinese tablet computer market plunged in the second quarter of this year, accounting for 28% of shipments. That's down from almost 50% a year earlier. Research firm IDC says that smartphones made by Samsung and competing products made by dozens of local Chinese companies have put the squeeze on iPad sales there.
Sales of kitchen appliances have been on a tear lately thanks to the turnaround in home sales and home prices. One of the biggest beneficiaries of that recovery, Whirlpool. Shares of the U.S. appliance giant up 83% over the past year, and the company recently added jobs and expanded its manufacturing facilities. Jackie DeAngelis now with more on this comeback company.
Dishwashers, washing machines, microwave ovens, just some of the appliances used to outfit new homes and upgrade old ones. Today, a report showed that existing home sales jumped to their best level since November of 2009, and Whirlpool is one of the top manufacturers benefiting from the recovery.
We think that home prices, as they appreciate, gets a customer to buy more appliances. The replacement cycle is really long on those products. So an oven can last 10, 20 years. So to get a customer to invest in new appliances before they break, they have to think that home prices are improving, that they're making an investment inside an investment that is appreciating.
And Whirlpool stock is benefiting from that, up nearly 140% in 2 years and more than 30% year to date. Still, analysts point out that Whirlpool's high correlation to the housing recovery could be its Achilles heel, especially if interest rates continue to rise.
They have talked about rising interest rates. We think we're at least a year off from that having any real impact on the results. So we expect at least another year of strong same-store sales numbers from the home improvement stocks.
Other risks include consumer spending on a slow uptick, but if the economy sours, consumers might tighten up. But for now, they're opening up their wallets.
The prices of homes have increased somewhat, so we felt more comfortable that this was, a comfortable thing to do for us financially.
I think it's more discretionary income. If you have income, and you want to beautify your place, that's one of the natural first places you would go to is like redoing your kitchen, new refrigerator, new oven.
Also, roughly 30% of Whirlpool's sales come from its international operations, and operations outside of North America typically tend to be more volatile. Still, investment firm Raymond James has an outperform rating on the stock, which means that it expects the company to outperform the S&P 500 over the next 12 to 18 months. For Nightly Business Report, I'm Jackie DeAngelis.
And finally tonight, are you ready for some football on YouTube? Google, which owns YouTube, is talking with the National Football League, and it looks like the search giant might make a bid for the NFL's Sunday ticket package, giving viewers streaming access to all games on YouTube. Right now, DirecTV pays about $1 billion a year for the rights to air that out-of-town game package, but that contract expires after the season, and Google, along with cable channels, broadcast networks, and satellite providers, are all tackling to win it.
And tell us the one stock, only one, you'd like our Market Monitor guest to discuss on Friday. Go to our website, nbr.com, and click on the link to submit your question. Be sure to tell us where you're from, and we'll maybe tackle your question on Friday.
Football on YouTube.
Football on YouTube. We shall see. Long way to go before that one happens.
That's Nightly Business Report for tonight. I'm Susie Garrett. Thanks for joining us.
And thanks from me as well. I'm Tyler Mattson. Have a great evening, everybody. We'll see you back here tomorrow evening.
Nightly Business Report has been brought to you by
Sailing through the heart of historic cities and landscapes on a river, you get close to iconic landmarks, to local life, to cultural treasures. Viking River Cruises, exploring the world in comfort.
I'm Susie Garrett with the Nightly Business Report news brief. No clarity from the Federal Reserve today about when the central bank might begin pulling back on its massive bond-buying stimulus measures. That uncertainty, along with more weak outlooks from retailers like Target and Staples, led to wild swings in the stock market. In the end, the Dow was lower for the sixth session in a row, falling 105 points, ending below the 15,000 level for the first time since July 3rd. The Nasdaq lost 13 points, the S&P off by 9 points. Hewlett-Packard netted $1.5 billion profit in the last quarter, but sales of PCs fell 8%. Sales of existing homes in July shot up 6.5%, far more than expected. But Wells Fargo is laying off 2,300 mortgage lending unit workers on a drop in refinancing. Be sure to tune into Nightly Business Report right here on your public television station.